Good afternoon and good morning, everyone, depending on where you are in Australia. My name is Joel Comerford, and I will be hosting today's webinar for you all. Um, we're excited to have Tim Quinn join us today on tax strategies for small business success. Now, today with Tim, for those who have never met him before, he is our head of tax and accounting at Lawpath and Tax and Advisory. Tim is a chartered accountant with 17 years of experience, and since that time, he's got more than enough experience advising businesses on tax planning, structuring, compliance, and financial strategy. He has worked as at the director level, leading tax divisions and helping business optimize their tax position as well. Very exciting stuff for those who have never met him or observed any of his webinars before. If you are behind on your BAS or tax lodgements from last financial year, or if you're unhappy with your current accountant, Tim and the Lawpath team can take care of all of that for you. So stick around until the end for a special tax compliance offer exclusive to webinar attendees as well. Now, what are we addressing on today's agenda? First of all, tax considerations for different types of new businesses, tax strategies for Australian startups, different types of startup expenses that are immediately deductible. How can Lawpath help you essentially with our guidance, assistance, and plans, etc. And then at the end, we'll also have a live Q&A with Tim as well. So later on in the session, I will open up the box for you guys to add in your questions. So if you do have some questions and they're not too immediate, keep them out of the question box and try to save them for the Q&A. That's where we really target a lot of those topics. Yes, so other than that, I think that should be everything from me. We'll just go ahead and drop into this. So take it away, Tim.
Thank you very much for the kind introduction. We do have some slides, so I'm not sure if I can pull them up on my screen or how we do that, but we'll get to it in just a second. Most importantly, hello to some return viewers. I've seen quite a few of you before looking at the guest list. Hi, Mary, and hi to any other registered tax agents or accountants on the call today. Always good to get a different perspective on these things. Feel free to sing out if you have a different position. So just before we start the slides, I'm going to insert my own one, which is the biggest tax strategy for small businesses today is unfortunately a bit of a sad closure notice from the Bank of ATO. If any of you have come across that or used the services of the Bank of ATO before, this is a commonly known financial thing that we've all lent on at some point in the other, where typically small businesses have put BAS and tax compliance down at the lowest of their priorities. So typically everyone's got bills to pay. The ATO has been the last one to get their cut. During COVID in particular, a lot of us lent on that Bank of ATO probably too hard. So the pendulum's swinging back the other way a little bit there. And what does that mean for us as taxpayers and for me as a tax agent? It means that where previously we would let these lodgements go, we'd let our compliance obligations lapse, we'd bury our heads in the sand somewhat, and we might say, I'll get around to it when I can, or even if I've lodged it, I'll get around to paying it when I can. Typically, all it took was a little phone call to the ATO, and one of their lovely client services representatives would waive the interest, would waive any penalties, and we'd be on our bikes and on we go. That has very much closed down. We're finding in our interactions with the ATO, it is harder to get interest remitted. It is harder to get penalties remitted. Bear in mind, when you're paying ATO interest from 1 July 2025, that will be non-deductible. We don't like that. We like paying deductible expenses. We like paying things where we get a tax benefit. We don't like paying for things where we don't. ATO penalties are already not tax deductible. They can be up to $1,500 per month, depending on how many late lodgements you've got. You may be a small taxpayer with a genuinely small tax impact in terms of how much you pay. It doesn't matter. The penalties will be assessed all the same. and losing out on that tax deduction is very, very painful. Likewise, superannuation used to be a bit of flexibility, pay it a little bit late, she'll be right. No longer. You pay your superannuation for your employees a couple of days late, you'll be required to do a superannuation guarantee charge, which penalties apply again, and the late superannuation will not be tax deductible for you. So we loved it while we had it, the Bank of ATO. It's closed. Don't mourn that it's gone. Be happy that you ever had it. Um, Look, we will just keep going without the slides. They're not too exciting anyway. And I've got 1 second, pardon me. Yep. We're solving the world's technical problems as we go. Here we go. And I'm now able to share. Fantastic. Okay, we've dealt with the Bank of ATO. Where are we up to now? The basics, the very, very simple basics. And a lot of people forget these things when we're talking about how can we reduce tax. Tax payable for a small business at least, 25% multiplied by your income minus your expenses, not rocket science. When we talk about minimizing tax within an entity, we are talking about primarily one of two things. These are the big levers that we've got to push. It's decreasing your taxable income or increasing your taxable expenses. As you might imagine, there's not much we can do about the tax rate. The 25% is what it is. It's certainly larger for larger businesses. So when we're talking about these two levers, there are no silver bullets, but they're worth paying attention to. These are the ones that really move the dial in terms of how much tax you pay within your entity, within your company or your sole trader business. Can you defer your income to next year? If you're sitting on the fence, do you want to take up that job on June the 29th? Could you do it on July the 2nd? Could you invoice accordingly? Sometimes, no joke, if this is a big invoice, put it off a few days. You might think that's crazy, getting less income to pay less tax. You're not getting less income. You're deferring it. Your timing is just a couple of days different. You can still get paid the cash. It's no real difference. Huge difference on when you pay that tax. Could be as much as 12 months. Do you invoice on milestones? Plenty of people do. Think about the timing of those milestones. If again you can afford to push one back a couple of days, do so. Much better off paying that tax next year. Kick the can down the road. The other major lever is your expenses. So a lot of people let this one go. They pay their super, 28 days after after the close of quarter. Fantastic. If you know that that June quarter superannuation is coming, and if you've got the cash in the bank, pay it before the 30th of June. Get the tax deduction this year. Again, you're doing the opposite of what we just talked about. Instead of deferring, you're bringing forward. You're bringing it forward by a few days, but you're bringing forward the tax benefit by 12 months. If you yourselves have the cash to put into your own superannuation, there's a deductible limit. It's $30,000 at the moment per person. If you haven't been contributing, which plenty of business owners don't, they've got better things to do with their cash. But if you've got the cash to do so, putting in that contribution just before year end can really add a huge deductible benefit, particularly if you're not that far off retirement yourself. You will have access to that money again in no time. Instant asset write-offs, we talk about that a little bit later on, but buying business assets below this immediately deductible limit, this can be an asset that you might use in your business for the next 10 years, but you've got the immediate tax benefit, that deduction upfront as soon as you pay for it and it's ready for use. Just a little asterisk on that one. They always pass the legislation late, so just do check with your accountant that it's in place before you make any big decisions. Prepay your annual subscriptions. Dare I say it, your Lawpath subscription. Doesn't matter that you won't be using the benefit until next May. Pay for it now, get the deduction now, get it all locked away. I said no silver bullets, so sorry if anyone's come to this webinar expecting an easy fix. These are the big levers that we push. Real tax efficiency comes afterwards. It comes after we've paid the company tax at 25%, because that's just the start of the story for tax for small businesses. We now need to think about what happens after we've paid that tax, that after tax profit. And I'm going to give you a few, not silver bullets, but a few golden solutions, a few structures that we can put in place. Plenty of people would have incorporated with a very, very simple structure, what we call a mum and dad PTY limited. Mum and dad as the shareholder, one share each, $1 each, and away you go. It's a great way to start a small business. It's low cost, it's low complexity, it's straightforward, it's easy to understand. But is it time to consider your options? Have you thought about the holding company? Have you thought about your IP protections if you're in the sort of business where you need to hold intellectual property separately for very good legal reasons that we'll talk about? Have you thought about diving headfirst into a family trust? You're not the first small business to have thought about family trusts for very, very good reason. These trusts have been around for hundreds of years. Our federal parliamentarians love them for themselves, so they're not going anywhere. And they're hugely tax efficient as well as providing really, really good legal asset protection benefits. So we'll talk about that in a little bit of benefits, a little bit of detail. When we are looking at structuring, we're considering tax issues before, during, and after. We're thinking about the startup to the business, we're thinking about how it runs, and we're thinking about exits. So if you haven't thought about your business structure for a while and you think that an exit to your business will be straightforward and low tax, probably time to get someone to have a peek under the covers. See if you're set up right now before a transaction is underway. Why do we talk about this dual company structure? Why is everyone putting a holding company above their trading company? For very, very simple reasons. I am not a lawyer, but I speak to plenty, and lawyers will tell you all about the idea of de-risking your business, of separating your assets, like your cash or your intellectual property, separating that from where you're risky. Now, if anyone has an operating company, they'll know that there are risks to any business, particularly if you've got employees. There's nothing to stop a bad actor for taking you on in federal court or Fair Work. Anytime you're dealing with customers, you might have big contracts that go sour. The idea of separating out those assets from your liabilities is if the worst thing happens and you're found negligent or liable, it's very difficult to attack the assets because the ill doing has happened in a vehicle that has no assets. So that's why we see it a very, very typical structure. From a tax and accounting perspective, it's really good to attract new investment. This can be in startup world from VCs, from other big funders, from small businesses. It can be just getting on a new equity partner. Having a head company or a holding company allows you to really easily take investment and not have to update 5 company registers with ASIC every time you want to make a change to your shareholders. You change it once and it's updated. That structure is very, very easy and very flexible to add to. So every time you want to add a new business to your stable, you just add a new operating company under the holding. It doesn't affect the rest of it. The rest of it goes on as it goes. So it's a really, really effective structure for that as well. And it's definitely something we recommend for people looking for a bit of flexibility. But the family trust, that's the level where we go from dual structure. Now we're thinking, why are we adding another one? Didn't we just solve all of the world's problems with our holding company? Well, in the holding company structure, who's owning the shares? It's still mum and dad, or it's still the business partners, the 3 business partners in the typical model. And that's fantastic. But think about what happens to the profits. We've tried our silver bullets, we've tried our levers, we've minimized tax to as much as possible. We've got this after-tax profit. Well, how do we pay it out? How do we personally get the benefits of our labor? If we own those shares as individuals, they are taxed to us as individuals. The mum and dad company is taxed 50% of the profits to mum, 50% of the profits to dad. That might be great. Mum might already have a job paying $200,000 a year. Dad might have made some big capital gains from selling some shares. You don't have any flexibility. Too bad. The profits go where the shareholders lie, and that can result in bad tax consequences. Family trust steps in. Family trust is a reasonably well-known legal structure by now. It involves the relationship between particular roles, the core one being a trustee owns property legally. That property can be shares. Although they own it properly, own it legally, they don't own it beneficially. So this trustee will own these assets purely for the benefit of particular other people. And the trustee has to decide in a family trust, in a family discretionary trust. But now that's fantastic. If we were talking about that situation, that mum and dad situation, where mum's already got a big salary, dad doesn't, fantastic. That trustee, whoever puts on that trustee hat, which by the way is typically mum and dad, they've typically formed a trustee company, they sit down and they say, well, we've got this profit from our business. Who gets it? It is completely legitimate for you to look at mum and dad's personal tax affairs and say, actually, this year, mum is going to get the income from this company and we will record it themselves. Even better, there might have been a capital loss in the business. We would send that to dad to reduce his capital gains. So you can be really, really clever. This flexibility is huge. I can't underestimate it. For a company that is profitably trading, the family trust structure is the number one way to reduce your tax, and it is completely above board. We can really minimize the tax. And of course, the asset protection, again, anytime you add a layer of legality or complexity between asset and liability, between risk and benefit, you're doing yourself a favor. You're making things harder to attack. Once you've got this structure set up, of course, you don't need to just stay at your business level. As you're building your wealth, your generational wealth, you might start to amass a share portfolio or other investments, or God help you, some Bitcoin or some Ethereum if you're more risk friendly than I am. Do that within your family trust. The benefits of owning these assets inside your family trust are, again, tax related and again, asset protection related. It doesn't just apply to businesses. This is really a fantastic vehicle to build your wealth in an effective manner. Now, why do we talk about share capital when we're talking about tax efficiency? This is a boring thing to talk about. This doesn't result in immediate tax benefits, but it's still important to get right. When we talk about tax benefits and we talk about raising capital, we talk about bringing on new investors. What is often forgotten about is the simple structure that you set up day one, only one share at $1. It doesn't work when you're looking to attract capital. Why is that? If you've got two shares out on issue for $2, one to each business partner, and you want to bring in a third, do the maths, you immediately have to give away 33% of your company. So we recommend when you're setting up a company, if you are looking to issue capital, issue a huge number of shares, issue 100,000. Why not? That'll be the way to do it. And then that way, if you need to issue new shares, you don't have to give away 33%. You could give away a much smaller number. If you haven't done that yet, that is not the end of the world. If you are set up with one, you can do what's called a share split. So don't worry if you haven't done this yet. It's easy enough to fix up. But just bear it in mind if you're looking to start up a new company. Now, your cap table, this can be simple, can be complex. Some of you will have seen these crazy Excel spreadsheets we go all the way from angel investors through seed rounds, A through F, all the way to exit. Even though it looks complicated, all it's telling you is that every stage of your fundraising journey, who owns what? It's a good way of getting a sense of, particularly for business owners, startup founders, how much of the company are you giving away? And what does that mean about what's left over? Obviously, the idea is capital raising is your slice of the pie gets smaller, but the pie itself gets bigger. So everyone wins. It's a fantastic exercise to actually understand what this is going to look like. I've certainly had lots of startup founders that have been gradually ground down by the fact that they are getting smaller and smaller pieces. I would get ahead of it, get an accountant who knows how to do these cap tables, who can help explain to you what is this business going to look like in 5 years. because those dilutions, if you don't expect them, can be incredibly rude. We did just have a question coming through. I'll just try and answer this before I move on to the next stage. We've got an IT business as a sole trader, require GST. If I activate GST on my ABN, will it? You can segregate the businesses. You can have an ABN for a sole trader. You can have an ABN for a different entity, but the GST registration is at ABN level. So if your ABN needs to register for GST, the whole thing is subject to GST. So sorry, I don't have better news for you there. Capital raising. This is one I often say I don't like complexity, particularly not for complexity's sake. I don't like hiring a lawyer just to hire a lawyer's sake. My colleagues might disagree. They'll be upset with me. This is one occasion where I would strongly recommend you hire a very good lawyer who has done capital raises before. The documentation requirements are significant. The issues, if you get it wrong or don't dot the I's and cross the T, are significant. Some of these documents require wet ink signature still in 2025. That is crazy, but it's still there. Do just hire someone who's going to dot those I's and cross the T's for you. Those board resolutions, if they're not done, they effectively never happened. So it's incredibly, incredibly important to get your record keeping up to date. This is a juicy one. If anyone has ever come across these ESIC, not ASIC, ESIC, early stage innovation company offsets, they are fantastic. They are well worth the investment of your time to look into. They are not for all businesses. They're not for a cafe. They're not for a services trading business that is the same business that's been done before. They are for innovative companies trying to do something new. The offset, the way it works is first you basically get love along the whole spectrum. First of all, you get a 20% offset, which can reduce your tax payable down to zero. If you had $20,000 of tax to pay, and you got this 20% offset that came to 20,000, if you invested 100, you have no tax to pay. This is huge. So it's a very important way that you can attract, not for mum and dad, it's not for the co-founders, it's for the next stage, the next group of people coming on board. If you're looking to sell a 30% or smaller stake in your company, what a great way to attract them by saying, hey, we are eligible for the ESIC offset status. Everything you invest, you're going to get 20% back as a tax offset. Not just that, a CGT concession, an exemption, dare I say it. You hold those shares for between 1 and 10 years. When you eventually sell, and all power to you, it's sold for a lot more than what you paid for it. Those ESIC investors will pay zero capital gains tax. It's huge. It's really worth going for. I do recommend it. Anyone that's running an innovative company and looking to raise funds, if you have not considered ESIC, please reach out to me. Please let me convince you of how great these things are to go for. They're not that complicated to get for. You can self-assess your eligibility. Let us lend you a hand. Just before I move on from ESIC, another question's come through. I already have a company. Can I set up a family trust now and put my company as a trustee? You can absolutely set up a family trust after the event. You can insert that at any stage. You would have to sell the company to that family trust. So alarm bells might be ringing that that's going to have capital gains tax payable. Maybe, maybe not. There are some pretty generous small business CGT exemptions and rollovers and concessions to restructure your affairs. If the ultimate beneficiary is still you and your family, we can actually help you put in that family trust in place and avoid any tax incurring at that time. So Jorge, and apologies if I've got your name wrong, please reach out and we'd love to help you with that if you need a hand. Pardon me, I skipped over R&D. I worked in R&D for 6 years. I can't possibly avoid that one. Research and development, tax offsets, or sometimes known as grants. It's not a grant, it's a tax incentive. This is the big dog out there for companies doing R&D to get real money back into their business. The reason for this is, yeah, it's a huge offset. It's 43.5% of your expenditure. for small businesses that we'd be talking about. But it's not just a non-refundable offset. It doesn't just reduce your tax payable to zero. If your tax payable was already zero, it'll go into negative and they'll give you a bank transfer for the value of that. The reason why this can be so valuable, imagine a really simple company, new startup, it's trying something unusual. The state of this, it's looked at the state of knowledge. This thing that it's doing, whatever it is, has never been tried before. You don't know if it's going to work. You're going to make a big play for it. You invest $100,000 in year one in trying to build this thing. You've had some success. It didn't work quite how you thought it would, but that's the nature of R&D. You get $43,500 back if you're eligible as a tax incentive. In year two, you might have to invest another 100,000, but you've got that 43,500. You reinvest it again. You get this multiplier effect where year on year, you are reinvesting this money from the R&D incentive on R&D, and it just starts paying for itself very, very quickly. It is a difficult thing to apply for. You can try and apply for it yourself. It's through Oz Industry, Department of Innovation. It is then through the ATO. It's a dual regulated business. Why is it being so heavily regulated? There have been some bad actors out there in the past that have overclaimed, have been very, very silly. It's notorious for having a few cowboy operators. That said, it is a legitimate incentive. There are also very many truly good professionals out there who understand the eligibility rules and can help you through it. Again, I would recommend that you do seek external help. I'd be happy to lend a hand. And there are some good people out there that do work in that. Because not everything is eligible, but if you're being innovative and you're hitting some of those things in the slide, it's worth a chat. ESOPs or ESS, they often mean the same things. They're used interchangeably in Australia. This is the idea that you're giving your employees or your employee-like advisors, they don't have to be strictly on payroll, anyone helping out your business. Often early days in business, cash is tight. You want to attract and then retain good senior staff. The way to do it is with an ESOP. The way to do it is to align the interests of these senior people and say, we might not be able to pay you that much in cash today, but we think we've got something good here. We think that you can add something good to where we're going. And if if I as the business owner succeed, you as my key employee will succeed too. And the reason is for every year that you're here, we might give you 2% of the company. 4 years in, you might own 8% of the company. You might then sell. You might sell to someone else and you will have a big payday. Fingers crossed. There are lots of different types of ESOP. It's beyond the scope of today to go through them all. A particularly juicy one is back from 2015, the ESS Startup Concession. This is particularly nice because it involves income tax on the benefit that you receive from your ESOP. It puts it into the capital gains tax bucket, which for those of you that have been on a few more webinars will know it's 50% concession as long as you've held those interests for more than a year. So we're already reducing tax and deferring what there is, which is fantastic. So it's a really, really great scheme. It's for businesses under 10 years. There are other ESOPs out there for older businesses that can also work very, very well. Small business tax concessions. There's plenty of them out there. Sometimes a little bit hard to find. They're not always the best understood. They're not always the best marketed by the government. First of all, first and foremost, there's the reduced tax rate. So we've got a lower tax rate here for small business at 25%. There's the idea of these immediate deductions, but back in the day, until fairly recently, you used to not get a deduction for starting up your business, which was crazy. They fixed that. You now get deductions for any of your associated sort of professional fees in setting up your business. There are also simplified depreciation rules and of course the immediate write-off, which we always just say treat with caution because the legislation typically is passed too late to do anything about it. We always expect that they will pass it and they'll increase it from 1,000, but just bear it in mind. The eligibility criteria, look, most of those have a turnover threshold of 50 million. Some of them have $10 million. So just check with your accountant that they're applying the right rates. What are these immediately deductible expenses? They're what you'd imagine. If you've come to Lawpath to help set up your business, you've obviously paid something out of pocket before that business even existed. Don't fret. You can still claim that startup cost from Lawpath or from someone else as a tax deduction in your business. Just, of course, let your accountant know to look out for the expense. Just tell them, hey, I paid this one personally because the company didn't have a bank account. That's no problem at all. We can still claim it. Um, it's going to be the government fees associated with setting up a new business. So if anyone's had to pay one of those pesky ASIC fees up front to register a business, don't worry, it's deductible despite the fact the business didn't exist yet. If you've had a reasonably complicated structure, you've needed professional advice from an accountant or a lawyer associated with setting up, don't worry. Immediate deduction. We like immediate deductions. We don't like slow depreciation. We like to get the benefit from day one. We move on and talk about budgeting. Now, budgeting is painful. There's no way around it. For anyone that's got a personal finance budget in their life, my hat goes off to you. I can't stomach sitting down and doing that level of complexity, but I certainly have a good business budget. The reason being, if you just go hell for leather and you just start playing at business, you start getting in there and selling and spending. If you haven't done a budget that underpins that, you don't really know how you're going. Um, it can be tempting to see the bank account going up and thinking that business is going well without a budget. You might get a very rude letter from the ATO informing you that you have $100,000 of tax to pay and you've got 3 weeks to pay it. That can really put your business in a terrible position. If you have your budget up front, if you say, look, I know when my pain points are going to be. I know I've got this quarterly payment I've got to make. I estimate it's going to be this much. Um, but hey, I've factored it in. I've put a bit of fat into my pricing. I've said, look, I actually need to make more money from each of my unit sales in order to cover this expected this cost. Anytime you're giving yourself that extra knowledge, you're giving yourself to look back on, you're going to be in a better position. It's very, very easy in Xero or MYOB or any of the good accounting softwares out there to actually input your budget and review your actuals against how you're going. It's very, very straightforward. You can have a look 3 months in, and this budget doesn't need to be set in stone. You'll learn more about your business as you're in the guts of it and operating. And maybe you adjust your budget and you can see how you're going against it. It's a fantastic tool to looking forward. I thoroughly recommend you spend the time doing it. Um, Worst case scenario, you do the budget and realize that it's actually not worth going ahead with your business. The value there is even better than for a successful business. Sometimes it's good to know when something isn't going to work out. So do your homework on that one. Just another question in there. The sources to get this information, the items listed on the slide. Well, the sources for what's deductible, the ATO is always an okay website to start off. The legislation is great if you like reading legislation like myself. But yeah, I guess the sources are all over the shop on that one. So thanks for your question. If you mentally travel down the path of this business, we've talked about structure, we've talked about how to reduce tax. What's the next natural thing? We're imagining that we're profitable. So fantastic. We're in the top 20% of businesses already in our imaginary business. But we're now talking about expansion. Now things are going so well, we might be investigating new lines of business. We might be trying out some new things. Great. We might be looking to go overseas, even better. Tap that juicy American market, tariffs notwithstanding. Do we need to split into a new company? You almost certainly will if you're going overseas. The reason being that if you're going overseas, you're probably going to pay some tax overseas. So maybe we need PTE Limited in Singapore or an LLC or an S Corp or a C Corp in the United States. Maybe just within Australia, we need a new company to do something different because we want to ring fence some particular liability issues. Okay, we can do it. It's not impossible. Our accounting software is going to change though. We're going to have to do some tracking. We're going to have to put some projects in place, things like that. How are we going to fund this expansion? It's a very, very big question. What is called non-dilutive funding, or which is a nice way of saying debt. Are we going to borrow some money from the banks or specialist lenders, or are we going to go out into the market and sell some shares? How are we going to pay for this? Because like with any expansion, it's going to be some pain. You're not going to make profits day one. How are we going to fund it? We've got a sales and marketing plan in place, or we're just going to wing it. Within our structure, is there tax leakage? Tax leakage is the worst. When you're going overseas into most of the countries that you guys would be thinking about operating in, we will have double taxation agreements. So we can, I was going to say alleviate, we can minimize tax leakage within those structures. Sometimes a little bit seeps out. Have we thought about any R&D grants? Often expansion can put you out of the running for those grants and those offsets, but sometimes it can deal you in. Uh, CFO, we can talk about finance teams. We will a little bit later, and we can talk about what a CFO does. And again, just making sure you've got budgets and forecasts. Finance function is a good time just to pause before we hit up the finance function. We've got Dean who's doing some consulting with New Zealand. Yeah, New Zealand GST is an interesting one. Once you hit New Zealand GST, New Zealand threshold of $60,000 in UNZAD dollars, you do have to register for GST. But just bear in mind that there are some carve outs there if you're doing business to business. We're just talking business to consumer here. So, Dean, happy to lend you a hand there. What's a good setup? Create a New Zealand subsidiary or keep in Australia? It depends on your if you're doing services and consulting, you don't necessarily have a taxable presence in New Zealand. You can just operate out of Australia, but happy to take that one offline with you, Dean. Tread carefully, but it's not as complicated as you'd think. Finance function. The finance function for most small businesses is you. It's you sitting in front of your computer with, I really hope, some accounting software. If not, I really hope you've got a spreadsheet. If not, I hope you've got a really good shoebox. The finance function is basically your entire team of accountants. That will typically just be you. You'll be wearing many, many hats. For a very small business, this is a great way to do it. We've really democratized access to accounting now, where there are these great cloud-based software. They're reasonably priced, they're reasonably straightforward to use, and it means that you can minimize your costs in the early days. But as you get bigger, it's going to take too much of your time. If you're in there noodling around in your zero file at 11 p.m. on a Friday night, you could be doing something better, like getting some sleep. If you're doing it during your workday, you could be building your business. So you'll get to a point where you need to expand your finance team. There's lots of ways to do it. Doesn't mean you have to go out and hire a full team of accountants. You can, of course, up your service levels from your current accountants. You can hire bookkeepers. You can get bookkeeping services. You've just got to be nimble. You've got to be able to grow in a way that doesn't overcommit you. You don't want to be hiring a bunch of staff if you're not sure. Dip your toes in the water with an outsourced finance function before you're really sure that you need someone full time. Month-end close, very traditional for accountants. Sometimes these days it's tempting just to go hell for leather and just keep recording transactions and away you go. A month-end close is almost like a pause. It says, not only am I recording my bank transactions, but am I doing these little annoying accountant adjustments to make sure my balance sheet is up to date? Does it really reflect the value of the business? It'll doing that, but month end as opposed to year end means that you won't be getting the same level of unexpected shock when your accountant puts through those changes on the 30th of June. Look, as you expand it, it's as powerful as you want it to be. If you need more information, if you need more background to your finances, if you need to understand something that you don't understand, getting an outsourced finance function is a fantastic way of building up your knowledge. Now, again, more bad news. I started off with the Bank of ATO. I'm giving you more bad news. The bigger you get, the more tax you're going to pay and the different taxes you're going to pay. For those of you that aren't there yet, this is what you've got to look forward to. There are some additional taxes out there. It's not just income tax on your profits. It's not just GST on the things you sell, the things you buy. Fringe benefits tax is historically terribly understood by small businesses because it is punitive, by which I mean this is a tax that we put on non-cash benefit to employees that are taxed at higher rates than the cash we give employees. What a crazy scenario. Why do we do this? How have we gotten here? Back in the 80s, I like to imagine, I wasn't working in the 80s, but I imagine it's, big collars, big shoulder pads, and these long lunches at Chinese restaurants where all of these non-cash benefits were being provided. It was the long lunch typically. American companies like to pay health insurance. We pay gym memberships sometimes, things like that. All of these ways of dodging the tax man and saying, I'm cleverer than you, rather than paying cash, which is going to be taxed as on payroll, I'm going to just under the counter give these non-cash benefits. Well, the general revenue, the Reserve Bank, the ATO, none of them really like this particularly. They'd rather you pay tax on what you get. So fringe benefits say if you give something to your employee as a benefit that is not cash, we are going to tax you for it. So we're going to treat you as if that employee has a top marginal rate of 47%. So despite the fact that they might be a reasonably low paid employee, they might be on $50,000 and therefore have a much, much lower tax rate. We're still going to tax that benefit at 49%. So do be very, very careful. There are exemptions. Anyone that's been to a work Christmas party, anyone that's got a $100 Myer voucher at Christmas, there are small and non-repeating. There are exemptions out there. But again, don't think that just because it's small, that you can get away with it. If you're treating everyone to a big pub lunch once a week, it'll be recurring and it will not be a small benefit. So, fringe benefits tax, please just be careful. Do talk to your accountant before you just start giving away non-cash benefits because there can be a sting in the tail. Payroll tax. Aren't I already paying payroll tax? You say, no, you're not. You're paying the tax on your employee's salary is called PAYGW, pay as you go withholding. That's the tax that you're withholding from your employees and you're sending to the federal government every time you're paying them. Payroll tax is a state level tax. So every state's a bit different as well. So if you're hiring employees in multiple states, my heart goes out to you because it's complicated. But each state has a little bit differently, where it can be up to 5.5% of payroll above a certain threshold. You'll pay to the state government. So in New South Wales, it's Revenue New South Wales. It's I think SRO in Victoria, something like that. You'll have to pay that. Can be quite complicated. Your reporting frequencies might go up. You might have gotten used to the idea of reporting just once a year or once a quarter. There are thresholds that you'll hit as you grow and expand where you have to do so more frequently, monthly, even some businesses weekly. So it can get quite annoying to put it brutally, honestly. As you're expanding and restructuring, there are capital gains tax issues to consider, both imposition of that tax calculation, but also trying to get it down as low as possible, trying to use some of the tricks in our arsenal to reduce CGT. Director loans are one that comes up all the time. Anytime you're looking as a director or as someone running a small business to borrow money from your business, it might be tempting. We've all been there. You might have school fees to pay, your personal bank account's looking a little low, your company account's looking a bit juicy. Tread with caution. If at year end you haven't repaid that loan, if that loan is sitting there, the ATO's first instinct is to say, what you have in fact done is take a dividend from your company without having paid tax on that money first. So it will start to put you into a world of pain. You can set these loans up properly. You can document them. It's called a Division 7A loan agreement. You will have to pay interest on those loans. So yeah, before you jump into that scenario of borrowing money from your company, do talk to your accountant, understand what it's going to mean in the long term, because these loans have to be repaid. Number of ways to do it. Family trusts, I said that the federal government will never wind them back. They won't, but there are some rules that'll limit just how clever you think you're being. Just like people used to distribute to their 4-year-old kid and expect to get away with it. They changed the rules there. The next stage of that is this Part 100A that all accountants are talking about. It does just mean some restrictions on how you distribute profits. They're common sense restrictions, and there's still huge tax benefits to be had, but just bear it in mind. I think I'm going to hand back to my colleague. How do you feel about that?
I certainly feel good about it. Thank you so much, Tim. Honestly, I'm sure I can speak for everyone when I say it's extremely, extremely valuable knowledge, and we're essentially all getting it for free. So Yeah, I love it. Thank you so much for your guidance and your wisdom. Look, I'm not going to go into too much information regarding our plans. The good thing about Lawpath is everything is available on our website. You can all see it there. I will be sending an email out to everyone at the end of this, and we will have a offer for 30% off quarterly on the tax plan for anyone who's interested. If you are, I'll just get everyone to put in a capital YES at the end, and we can go from there. I will be sending out with every email this afternoon. It will have the slideshow with all the notes as well. And for those who don't know, or if you have to leave early, we do upload every episode to our Lawpath YouTube platform. So just type in Lawpath on YouTube and you can see every episode. We usually try to upload it every afternoon of the webinar day, or it'll be the next day as well. So essentially, ladies and gentlemen, why have you joined us today? It's because essentially you care. You've created a business or you're going to create a business and you're passionate about it, which I have no doubt. Otherwise, you wouldn't be spending an hour with us here. Now, for some of you, the topic of accounting and tax may be terrifying. Certainly, if I was new to the whole company structure, I would be absorbing as much as possible in regards to these webinars. So it doesn't necessarily have to be terrifying. Now, if you have found the way in which Tim conveys all this information, if it's been clear, concise, and comforting for you, then please become a client with us at Lawpath and allow us to extend this wonderful wisdom with you. All of the lawyers, accountants, and the tax agents have the same level of disposition, the same level of patience and kindness and understanding. So you are going to get exactly what you need. And as cliche as it sounds, Lawpath genuinely does care about Australian businesses. Our pricing and services should be a good indication of this. We want success stories over here. And if you guys are doing good, then naturally we look good. So it's a scratching each other's back kind of situation. If you're new here, the accounting plan, it's unlimited 30-minute consultations a day for 12 months with a senior chartered accountant. They will teach you how to do all your payroll, all of your bookkeeping, business structuring. They'll also assist you with any BAS related information just before you move into tax as well. If you want to be able to reduce as much money leaving the business and keeping as much money within the company as possible through tax minimizations and dividends, etc., then we can certainly help you with that. Now, in regards to the tax plan, if you do not want to, if you don't want to have the hands-on approach and you just want someone to just do your taxes for you, the tax plan can do that. Tim and his team Tim's team essentially will be doing all of your BAS statements for you, your tax returns, your end of financial reporting, and obviously you will have an initial consultation so you can really get a great amount of information from them as well, as is what's been discussed in this session. That's pretty much everything. In regards to the legal, if it's something that you wanted to hear about but wasn't necessarily mentioned in this, i.e. the topic today, legal is the same as the accounting. You get unlimited 30-minute consultations with a lawyer. You get the entire and access to our entire document library, which is over 540 at this point in time. We are a platform that is really taking on the online AI approach. So click of a button and you have a consultation with the lawyer and accountant. There's no 3 or 4 day waiting periods. There's no ridiculous process of trying to hop on a phone call, confirm if the lawyer accountant's available, back and forth, back and forth. It's you hop on, you book a consultation before 10 a.m. Usually you'll get a same day, or it'll be next day. Convenience and money saving is what we specialize here in over at Lawpath. Now, if you were interested in getting the legal accounting and tax, or the legal and accounting, or tax and accounting, whatever it may be, we have offered a new system called our bundling system, where any plan that you bundle together, we automatically reduce it by 40% off. And all of this will be available on the website. And as I mentioned, I'm more than happy to hop on a call with you afterwards or tomorrow, depending on how busy you are today. And I'm happy to go through all of this as well. If anyone is interested, but they just don't know how to operate the platform, I'm more than happy to hop on and organize a demonstration with you to convey as much information as possible.